Good evening, everyone. Welcome to the Q2 2021 results presentation this evening. Let me begin first on a good note. The icon of Delhi, the Taj Mansingh, or the Taj Mahal Hotel Delhi, as we popularly call it, is now open, and the lobby is fully renovated with the Emperor's Lounge and the machan with which a lot of Delhiites have grown up with, dating back to 1978, is open and running and has been restored to its old glory. I think this is a very, very important hotel for us, and we are very proud that we were able to retain this in our portfolio. Now let me move to a little bit on the macroeconomic circumstances. As we are all aware, we hear it in the news, we read it in the newspapers, there is a contraction in the global GDP by more than 4%. And within the global distress that is there, tourism and hospitality has been hit the worst. There is a $5.5 trillion estimated loss in this segment, and approximately 200 million in jobs. And when it comes to India, the latest IMF projection was a bit north of -10% on GDP. And I'll come to the figures on the loss of revenues in India and also on the possible loss in jobs in a minute. I think it is time that we took stock of where we are coming from. If we go back into this year, 11th of March, I remember very well that the visas were cancelled, and 13th of March, the OCI travel was also cancelled. Then we had a national lockdown, which was announced 2 days post the Janta curfew on the 22nd of March, and then 24th midnight onwards, we had the lockdown, initially till 15th of April, but which kept getting extended till almost September in certain states, even in October. The flights then on a domestic front started resuming around the end of May, that's the 25th of May. We had the first Unlock 1 on 8th of June, followed by a very important state for us, Maharashtra, allowing 33% of hotel rooms to open and not food and beverage as of 8th of July. And then we started international flights under air bubble on the 17th of July. In August, the hotels started opening up in Delhi. And Maharashtra then announced in September the opening of the hotels. Of course, the restaurants in Maharashtra with limited food and beverage activity followed on the 5th of October. Well, when coming to India, of course, it's an unprecedented downturn for the Indian hospitality sector. The branded hotels seem to have lost more than 31,000 crores in revenue, and if we have the unbranded also, then it comes to 1,11,000 plus crores. Hotel occupancies, when compared to last year April versus this year April, fell from 75% to just 7%, and there was a 55 to 60% drop in average rates, which is an expectation not for April, but for the calendar year 2020. That means from January till December. And these figures are based on estimates provided by Hotel Evate Research. And therefore, a total loss in hotel revenues from Jan to December is estimated at 1,42,000 or 1,43,000 crores. Now, having said that, there are certain clear trends that are emerging in travel patterns and guest behaviors. Some of these are short-term, some of these are mid-term, and some are there to stay forever. However, what we are witnessing is that the consumers are gravitating towards trusted brands as safety is the highest priority. There is an increase in the last couple of months in domestic and regional travel. However, the booking windows are shorter, and there is a willingness to pay premium for flexibility. This we had not seen pre-COVID, that people pay premium. There was usually a bargain. There is a shift in the purpose of travel, And if there is any travel at all in business, it is always linked to leisure, which we popularly call as bleisure segment. There is a change in type of travel. It's more staycations, more drivecations, even though you have to drive for 10 or 11 hours. There is a multi-generational travel happening. That means the grandfather, father, and the grandchild may be traveling together, which was not seen that often before, and mostly to remote locations. There is a surge in new products, vacation rentals, home delivery business, car rentals, and homestays. Having said that, I think what we announced in the last quarter when we came up with the results was our strategy, our 5-pronged strategy, which we called Reset 2020. And just as a reminder, the Reset stands for revenue growth, excellence in our operations, spend optimization, effective asset management, and being thrift and financially prudent. I would now like to walk you through some of the revenue initiatives that we have introduced under the Reset 2020. The first one, obviously, is Qmin, which is our home delivery business in the first half of this year, and although it was launched towards the month of June, of 10 crores in enterprise revenue, more than 34,000 orders till date. I can even tell in October, despite Shraddh and Navratras, we've had a good October. So this revenue is increasing. We've just opened in a soft opening phase our first Qmin shop, a gourmet shop at the Hotel President in Mumbai. And in the month of December, that means as of next month, we'll be launching our Qmin food truck business, and 3 trucks are expected to go live. Hospitality at home, we started very early in the lockdown phase, almost towards the middle of April. That's also done around 14 crores in business. That is, delivery of hampers and different kinds of hampers. We've come up with 3 different possibilities, which was very well accepted. And with the festive season round the corner, we are seeing a lot of surge in that kind of sales. Very proudly, our first announcement on our platform that we have with AB InBev, we just launched the Seven River Brew Pub in Bangalore, and in 40 days, it's already done 60 lakhs plus in revenue. So some of these is not all the F&B innovations, but I think these are the most significant and relevant ones which we wanted to share with you. With that, I move to how we went about unlocking the potential of domestic business. We had introduced our 4D strategy, or 4D marketing initiative, which was you dream, you drive, you discover, and you delight yourself. This contributed more than 27 crores to our H1 enterprise revenue, but I'm also happy to report that this was also launched around June, and since then it has picked up significant momentum, and we expect this to be a very large contributor to our revenue by end of March. Another important factor which we did not stop doing in this phase is lose sight on our growth. We have signed 8 new hotels in the first half of the year. Obviously, our focus, as you will hear a little bit later in the presentation, was stronger on asset management instead of just signing new contracts. But some of the good opportunities we did focus on, and we signed 8 contracts, added them to our pipeline, totaling around 750 keys. A snapshot of few new openings that are coming. In this month, we will open the Taj Skyline in Ahmedabad. It's a large property. It's on a management contract. Then we'll open the Vivanta in Trivandrum or Thiruvananthapuram, followed by the Taj Wellington Mews in Chennai. This will be the first property in India that will be run by ladies or associates only, whether in engineering or as general manager or as a chef or in the housekeeping area. And finally, the Taj Chia Kutir in Darjeeling. So we are quite hopeful that in the next 90 days we would have opened these 4, but we expect to open around 10 hotels by 31st of March. And one important opening that is not mentioned here is, as expected around the 10th of November, is the Connaught in Delhi. On the excellence initiatives, we have remained very focused. As you would all know, we launched as one of the very first companies, Tajness, a commitment re-strengthened. Why re-strengthened? Because Tajness was always there. Our care to safety and security of our guests was always there. However, we have re-strengthened it with the new norms of WHO and the Ministry of Health. Our NPS, Net Promoter Score, has grown consistently even during this Corona phase. And as you would have all noticed, we have been winning hearts and getting a lot of accolades, recognitions on various platforms. Whether it is Rambagh being rated as the top hotel in India or among the 15 best in the world, or it is our properties, the Pier in New York from Condé Nast, or the Maldives Resort, the Taj Mahal Palace and Tower in Mumbai for 3 years in a row as the best hotel in the world from TrustYou, the Lake Palace in Udaipur, the best resort, Taj Exotica in Goa, and this goes on. I think we have a lot of iconic assets, and they do win hearts and minds and souls of people handing out these awards. When we move on to our spend optimization initiatives, in Q2, we had the same result as you see in Q1. We had a 51% reduction in the cost. In Q1, the main reduction came from the variable cost and marginal reduction from the fixed cost. But as you see in Q2, that number on the fixed cost reduction increased by 30%. And as obviously the business grows, the revenues grows, the variable cost reduction becomes lesser. But in all, we were able to maintain a minus 51% control on the cost. And as management, we are very pleased with that number. When we move forward on where these costs optimization, on which heads it came from, it's of course the raw material costs as the revenues have dropped to such a significant level, but also on the admin expenses, on heat, light and power expenses. These are semi-variable costs. We had good success in controlling them. Our fixed lease costs, which we'll talk about a bit more in detail, and as I alluded to you on the asset management focus of our development team and our operations and finance, has helped us a lot in the fixed lease cost reduction as well as manpower costs by almost 40%. When we move further into effective asset management, and here it comes to how we secured significant lease waivers, and at the IHCL level it is 31 crores, on subsidiary levels it was 37 crores, on group companies 24 crores, so totaling 92 crores of reduction in this cost, and the benefit received in H1 2021 for IHCL and subsidiaries amounts to 42 crores. Moving on to the thrift and financial prudence, I think on this we did quite well. We saved 43 crores versus last year same time in the first half of the year, and we achieved this by exercising prudence in all corporate expenditure, especially redeployments and restructuring. When I say redeployments, it is because of our growth. We have an opportunity to redeploy our associates in new properties that are opening up. We also have an opportunity to redeploy some of our people in other companies within the group that are growing despite the pandemic. And so we are very content to have had that opportunity and have done successfully. And we feel that this number would only go higher because the redeployments did not happen in the month of April or May. It took time for it to kickstart. So most of the amounts that you see, they are really an impact of mid of June till end of September for the first half of this year. Then further on the liquidity, we have taken multiple steps. We have drawn drawdown in IHCL on 750 crore of long-term debt from April to September. We have secured additional lines for any further requirement. We are exploring on a daily basis monetization opportunities. It was part of our Aspiration 2022 strategy. It's a part of our reset strategy, and we have deferred any non-essential capex and renovations that could have been deferred. So therefore, if we were to summarize on the revenue growth initiatives, we had 135 crores, which would be a not like-for-like revenue versus last year same time. That means the source of this revenue is the new revenue initiatives and not what we had last year. We had spend optimization, means control on cost of another 149 crores in first half. Then on effective asset management, around 46 crores and 43 crores of corporate overhead reduction. With that, we move on to some of the performance highlights in terms of how our portfolio of brands have performed. Now, these are figures based on all brands. If we look at the RevPAR on the domestic hotel spaces, we see some early signs of recovery. As I mentioned in April, from 75% occupancy last year, we went down to 7%. Of course, the RevPAR dropped to 340 approximately, and it is up to 1,340. So 1,000 rupees have been gained on the RevPAR, and now this is on all portfolio, whether the hotels were operational or not operational. When it comes to operational portfolio, the drop was to 700 in April, which is more than doubled from April till September. So if we look at it this way, there is also a 4x growth from April to September if we looked at throughout the entire portfolio, but on the operational portfolio, it's more than doubled. In terms of our performance to the industry, IHCL had in Q1 a RevPAR of 513, which grew to 1,061 end of September. That is 2.1x. The industry RevPAR based on STR Global that we have received was at 465, which went to 796, so 1.7x. And we are seeing a large growth, especially in Q2, on our portfolio. And this is really for two reasons. I think one is because we do have a lot more resort assets, so which helps because the demand is really domestic and is leisure driven. But the second reason is also the trust, which I alluded to. There is a trust in the brand, especially Taj, as one of our brands is benefiting significantly from the trust and the love and the emotion of the people. And it is currently outperforming its competitors in almost all markets with the exception of one. Going forward, I think it's very interesting to see the slide on Ginger. As you will see, Ginger also came down from very high occupancy to low occupancy in the crisis, but it was the first one to recover. And in September, it already went north of 50%. I can also inform you that even October, it finished north of 50%, and its RevPAR index grew from 0.7 approximately in April to almost doubled or more than doubled at 1.48 in September. And we are very pleased with this also because Ginger as a brand has already achieved for the first half of this year 53% of last year's revenue. Now, as we all know, most of the companies struggled in Q1 and most of the brands struggled, I mean almost all, but I think Ginger has shown a lot of resilience and we thought this slide is worth sharing with all of you. Another thing when we move forward, you see the decline in revenue was as dramatic as we are seeing the increase in numbers on a month-by-month basis. So as we hit a low in April, going down to as much as 35 crores, in September it almost went close to 150 crores. And when we move on to the EBITDA, which was negative in April at 100 crores, has actually turned positive in September, and the trend continues that way, that the losses are getting narrowed on the PBT level and on the PAT level, and the EBITDA is turning positive, and we see no reason why this trend should not continue in Q3 with similar kind of increases in all these four segments of revenue, EBITDA, PBT, and PAT. If that's a kind of a, without giving a number to it, a kind of a guidance in terms of trends. Coming to our consolidated performance, in Q2, we had a total revenue of 324 crores. That's increase in over Q1, the 150 almost. We narrowed the EBITDA loss from 234 to 83. That's an improvement of 151. I think more important is that although there was an increase in revenue of 149, the EBITDA improved to 151. So the flow through that the management team has been working on has been quite positive. We have also narrowed the losses on PBT level at 263 versus 336 in Q1, and PAT from 280 going down to a negative of 230, which is another improvement of 50 crores. With that, I would like to hand over to my colleague, Mr. Giridhar Sanjeevi, to take you through the details of the financial performance.
Yeah. Thank you. Moving on to the consolidated financial performance, the details. I think as we can see, the Q2 revenue was 324 crores, which we represented as compared to last year's a decline of 69%, but represented a significant improvement from the first quarter number of 175 crores. In terms of expenditure, as was highlighted earlier, we continued to maintain total expenditure as at 52% as compared to last year in Q2, which was the same levels for the entire H1 as well. This is driven by all-round focus on all the lines of costs, corporate overheads, employee benefits, and all other lines of costs actually. On finance costs, the finance costs were steady at around 97 crores, and H1 was at about 185 crores. We had an exceptional of 20 crores due to some exchange gain loss on all derivatives. We ended the quarter with a loss of 230 crores, and the total half-yearly loss is 510 crores. Moving to the next slide. This is just some details of exceptional items. I think in the current quarter, lease concessions comes as part of the top line, and we have revalued some of our liabilities in relation to the purchase of the C-Rock shares, and that gives us a gain of about 23 crores. I think those are the two exceptions worth noting this time. Move on, please. In terms of the standalone reported revenue, we reported a revenue of 215 crores. Expenditure was at 253 crores, which was minus 47% as compared to the previous year. It was at the similar levels even for the entire H1 at minus 46 crores. Finance cost was at 69 crores. There was some marginal exceptional gains in this quarter of about loss of about 16 crores or so, and giving a net loss after tax of 142 crores. And for the H1, the net loss was about 380 crores for standalone. Moving to the standalone exceptional numbers, I think, as you know, we do provide for the US losses, and that was about 29 crores in the quarter. Move on, please. In terms of some standalone revenue metrics, essentially what you see in H2, in Q2 from July to September, is that between August and September, clearly you see a steady improvement in occupancy. You see a significant jump in ARR from 4,500 to 5,000 to 6,500. That's a significant jump in ARR. And RevPAR also going up from 1,400 to 1,500 to 2,200, a 50% jump plus in terms of RevPAR. And there was definitely a shift in business. Post-August, we saw the quarantine business come down and the regular FIT business coming up actually, and those are reflected in the numbers of Q2 and September actually. Similarly, on the domestic revenue, the network business, we see the same impact where the occupancy does go up by 6% or so, from 26.8 to 32.4. ARR, there is a significant jump of about 10% from 3,645 to 4,100. And RevPAR, of course, you see a significant jump of nearly 50% in RevPAR. So that is reflected in the domestic network metrics as well. In terms of the debt position, I think we continue to be prudent in terms of drawing down on debt. We are well managed we are well positioned for liquidity. Our net debt in standalone as of September 30th was 2,100 crores and consolidated was 2,900 crores. Weighted average cost of debt continues to be well managed at 7.8% for standalone. Net debt to equity is still comfortable at 0.5 or so, and net debt to EBITDA on a 12 months trading clearly has gone up to 4.97. Consolidated numbers similarly are 6.7% for debt. Net debt to equity has been about 0.68, and net debt to trading EBITDA has been about 7.54. So overall liquidity position remains comfortable. I think before I end, I just wanted to highlight some trends which are relevant for IHCL. I think these are external trends and those which are relevant and within the IHCL circle of influence. From an external macro trends perspective, very clearly in India, we are seeing that the COVID cases are going down. There's a 30% drop in new infections, and that augurs well. I think that has allowed the government also to reopen all the hotels and allow restaurants and all other parts of the hotel operation to open. Domestic air traffic is definitely going up, 40% improvement in September versus August, and steadily we have been seeing, if you look at the airline results, you're seeing that the air traffic numbers are going up. Domestic tourism is definitely going up, and there is almost like a revenge travel in terms of, especially in the leisure destinations actually. So you're seeing a lot of domestic tourism and leisure travel rebounding, and some of our destinations like Goa, Rajasthan, Rishikesh, and other leisure destinations are doing very well actually. And as was described earlier, Taj as a trusted brand stands to gain more, and people are willing to pay a premium for all their travels actually, and that is something which is important for us actually. And within IHCL's control of influence, very clearly we are focused on revenue, including the new lines of revenue through our reset initiatives, and there's a visible increase in revenue month on month, and we hope that will continue. And we are in the season at this point of time, and with the unlockdown and being in the middle of the season, we do believe that this quarter and the next quarter, we will see the momentum in terms of revenues. Very strict cost control and spend optimization is there. You've seen it in the 52% cost savings during this quarter. We have outperformed the competition in key leisure markets like Goa and other key metros. Ginger Hotels has exhibited very strong performance, exceeded and sustaining 50% plus occupancy levels. And we continue on our growth momentum in terms of opening hotels which are asset light except for one property actually. So I think we continue to sort of watch the external environment and do all that we can in terms of optimizing revenues, managing costs, and managing balance sheet and liquidity. With that, I kind of open it up for questions.
Thank you, sir. Participants, if you would like to ask a question, please signal by pressing *1 on the telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press *1 to ask a question. We'll pause for just a moment to allow everyone an opportunity to signal for questions. I would also request everyone to say their name and the company they belong to before asking a question. We will now take our first question.
Yeah, hi, this is Achal from HSBC. I wanted to understand a few things. So first of all, if you could please talk a bit more about your new revenue initiative. You have given 135 crores of number, as in it's a new revenue from the initiative. How much of it flew through to your bottom line? So what I wanted to understand is that if you could talk about the profit margins you earned in your different revenue initiatives like Qmin and all. that would be very helpful, please.
Okay. Should I take it, Puneet?
Yeah, you can. I will add.
Yeah.
I want to add.
Yeah. No, I think if you look at businesses like Qmin, I do not know if you have experienced Qmin in terms of the F&B. I think the average ticket for two people is approximately 3,500 to 4,000, and when you sell at the same prices as the restaurants, the margin on this business is very high because we are not discounting these. These are not Swiggy type of revenues. Hospitality at home also, these revenues are all at a full pricing actually. So some of these initiatives like Qmin and Hospitality at Now are completely at full pricing. The 40 initiatives which are in terms of taking advantage of the leisure destinations and maximizing those, the 27 crores that was pointed out, these are also at a significantly good ARR levels. So therefore, I think there is no compromise at all in terms of the margins on some of these initiatives. Puneet, you want to add to that?
Yeah, I think there is, just to add to this, a lot of these businesses are incremental. So the costs are incremental and so is the revenue. So for example, Qmin, it's the same kitchens, it's the same chefs, cooks who are preparing it. The incremental cost is really the raw material cost and the cost of delivery. We are also not using a third-party provider, so that makes the margins even larger. And we're looking at margins, on most of these businesses, I would say, as a hybrid north of 50%. And why north of 50%? As I said, this is not where we have deployed capital in building a space. It's using the existing spaces and using the existing facilities, existing manpower, the cost which we would have had anyways. Also, I think the same thing on Hampers or the Hospitality at Home, the same on the 4D initiative. And I think there is a lot of wellness retreats that we have launched, staycations that we have launched, temporary office working that we have launched. And you will see more and more of this coming because partly we have to adjust our business model to the new reality, and we have to try to find latent demand that did not exist before and try to capitalize on it. But yes, one line answer is all these businesses are very high margin business because we cannot be on one hand saying we will not be doing any capex and actually reducing and deferring any planned capex, and that's how it makes the model very, very asset light.
Right. So is it fair to assume that out of the total new revenue of 135 crores, almost like 60-65 crores or more or slightly more would have flown to the bottom line, right?
Absolutely, it's fair to assume that.
Perfect.
Even a little higher number.
Yeah, sure. No, by the way, I use Qmin, and it's a great initiative. It's a great thing to be fair. The other thing also I wanted to understand about the cost evolution. So how, so of course you maintain your 50% cost decline. How do you see it going forward as the business picks up, as you open more hotels? So I think some of your employee costs will come back and all those sort of things. So how should we expect your cost would evolve over the next 2 quarters at least, and then probably if you can talk about a bit more in the next year?
Sure, I would go first, and then maybe Giri, if you want to add something. You see, this is a historic opportunity also. As bad as this COVID news has been, it has been an eye-opener for the global hotel industry to, check every cost that we had. And not that we were not looking at costs before, but when your revenues come down to almost a zero level and the hotels are shut, then you have all the time to keep looking at every possible cost 10 times a day than you did when it's business as usual. My personal opinion for the industry and especially for IHCL I would say, let me limit it to our own company, is that we came up with this reset strategy, and that means it's also a reset on the cost base going forward. This is not a temporary thing. We don't do those temporary things. We have not furloughed any staff. We have not taken employment away from anyone. Our salary contributions that we have done, we have created Taj for families, supporting staff who have lost jobs because they were not directly employed by us, rather by one of our partners or something. So that way, I think we do see this as an opportunity to come up with new operating business models, and we are doing that. We're going to redefine our business class rooms proposition, our business, Taj Club Lounge proposition. Everything will be reset for the time coming ahead of us and going forward. Giri, if you want to add something to it.
No, that is right. And I think what you saw actually in the first quarter was the reduction, which was more in the context of variable costs. And as we go forward in Q2, we have seen that the cost savings are more in the fixed costs, and we will see much more fixed cost reductions coming through. In fact, if you see the Q1 fixed cost number last year, it was about 156 crores. It came down to 123 crores per month. And in Q2, that came down from 157 to 112. So therefore, I think there's a lot of focus in terms of trying to drive down the fixed costs. And as Puneet said, it is all changes in operating model and trying to make fundamental changes in the way we're working, starting with the corporate office to everywhere else actually. So there's a very strong focus on improving the cost base actually.
Great. So basically, I'm assuming that these cost efficiencies would continue even if the full business pick up to the original scale, and then that will benefit, right?
That is right. That is what we want to do. In fact, one of the things we talk about is that in the previous year, we needed 4,500 crores of top line to generate, say, 1,000 crores of EBITDA. I think the attempt is to say that can we do it at a much lower level, similar EBITDA at much lower levels of top line. So therefore, I think the focus is very clearly there in terms of bringing down the cost base to a different level actually. Absolutely.
Right. Fair enough. The other thing I also wanted to understand more about the change in customer mix. So until recent quarter or the quarter of September probably, you would have had many people saying, so most of traffic would have been driven by the COVID, the medical staff and quarantine people and also, and then that must have been changed or that must have been replaced by the normal leisure demand. So just wanted to understand if you could talk a bit more about, what kind of change are you noticing now from your traffic in the quarter to September to now this starting quarter of December and
Yeah, I think what I can say is that with the change in with the reduction in the quarantine flights, what we are now seeing, as we had predicted earlier, the leisure luxury business picking up, the weddings picking up, and therefore, and what we are seeing in terms of some of the destinations like Goa and Rajasthan and other destinations, we are definitely seeing people willing to pay and kind of take there and stay in all these hotels. So therefore, I think it's more exciting. It's more domestic tourism related. No international tourists are clearly coming, but therefore people are willing to pay, and that is really the change here.
Sorry, looks like the participant line has been removed from the Q&A section. Participants, please press star 1 on the telephone keypad to queue up for questions. We'll take the next question. Line is open. Please go ahead, sir.
Sorry, am I audible?
Yes, sir.
Sorry, I think my line had some problem. Giri, sorry, just continuing that question. So the destinations which you just talked about are more of a sort of a leisure destination. So probably that highlights that there's some recovery in the leisure demand. But how about, because if you see air travel, there is a lot of recovery in leisure demand, there is a slow recovery in the leisure demand, but more of a MSMEs travel which is taking place. So if that is the case, what kind of traffic recovery you are looking at in terms of business destination like Mumbai, Bangalore, Delhi and all?
Business travel clearly is slow. You're right that the MSME business has picked up in terms of travel. And that is one of the reasons why you see the incremental occupancies also coming through in places like Ginger, where the occupancies have gone up above 50%. So Ginger clearly benefits with that segment. As far as the premium hotels are concerned, I think it is more leisure luxury than business travel.
Right. Last question from my side. I'm really sorry for a bit of long list. In terms of liquidity, so if you could please guide us on what kind of cash burn now happening on per month basis, that'd be helpful.
No, I think between cash and lines we are more than 1,000 crores, and I think we have been very prudent in terms of expenditures actually. And I think the good news in this business is that as the revenues pick up, as they have started to, the requirements of cash drop. So we believe that we are well protected for now in terms of liquidity.
But how the cash burn has improved versus the last quarter?
I think cash burn is definitely improved. I think in the initial months it was up to 100 crores a month in terms of cash burns. But I think operating cash burn now has come to less than 50 crores or so. Of course, there's always other things which come up. But and this, as it goes forward, hopefully should drop. But we'll keep a close track of it.
Okay.
I think it could be fair to say that it would be fair to say, given the current business on books and whatever we know, we should be cash positive as of November. Because we have the wedding season which is kicking in, we have the festive season which is kicking in, we have no Shraddhs, we have no Navratras, which was there in October, and October also ended up in a similar trend as September was over August, October was over September. So if November goes that way, then I don't see that we would have need of cash burn. But that's all if and but. What we can see today for the next 3 weeks, it does look that the jumps would be similar.
Right. Perfect. Thank you so much and wish you good luck.
Thank you, sir. Participants, I repeat, please press star 1 on a telephone keypad to ask a question. We will now take a next question.
Hello. Hi, thanks for the opportunity. Sir, first of all, during your opening statement, you have talked about, this is Vikas from Antique. So during your opening statement, you have talked about that you have deployed the employees in other group companies, and clearly, one of your group companies hiring pretty strongly. Is it possible to quantify what % of the total employees we are transferring to the other group company?
See, it is not just transferring people. I think the strategy that we announced 3 years ago was the 3R strategy of reimagine, restructure, and re-engineer, right? When we reimagined our brandscape, we needed certain skill sets, so we hired certain kinds of people. In order to re-engineer our margins, we started changing the business model. And restructuring is as per the needs of today. So there are different examples at corporate level, and I did mention that we have the ability to redeploy because of the needs and wants of business are different. So as an example, when we opened the Connaught in Delhi, almost 100% of the employees there are from other group, properties. So whether they are from Taj Mahal Delhi or they are from Taj Palace Delhi or from Vivanta Dwarka or from Taj, even from Taj Wellington Mews in Mumbai. So the growth provides a normal progression for the employees, and we are able to, become more efficient in the operations, and that's one kind of redeployment. The other redeployment is, as an example, if we club the functions of a couple of departments. So recently we aligned revenue management and finance into one function. And that way we don't need to, because one person retired, so the other one could take over two jobs because it's both is numbers driven. And that's another example. The third is there is a possibility as one of the group companies, as you said rightly, is expanding, and we would be working with them very closely. We are on the human app, for example. It's good for them to have some people from our own system because it will help them in doing a super app and addressing the needs and wants of our business. So that's how we have been very, step by step mindful of our also midterm and long-term needs, because, just redeployment is not what we do. We have to address in a very smart way the talent that is needed to take the company where we wanted to take it to, where we were 80% there on the pre-COVID level, and how we are going to get to the 110% there in the next few years. So I don't think that kind of a quantification would be. You will see the results in our corporate overhead quarter-on-quarter basis, if that's a way to answer it, but we cannot quantify these kind of numbers. Giri, you want to say something on this?
No, I think that's fine. I have nothing else to add from you. Yeah.
Okay, my bad. I thought the move is more to do with managing the employee cost in the near term. Second, my question is on the corporate side, how the demand is shaping up, and I'm looking for this answers more from a medium term perspective and not near term, because clearly most of the tech and consulting companies are talking about medium term saving coming from travel and work from home with the use of collaborative platforms and all. And the dichotomy is, when we look at the smart money, private equity players especially, they continue to invest in commercial space. So just want your view on this and what you're hearing from your corporate clients. Do you think the mix between leisure and corporate travel will change meaningfully? And again, I maybe from 3 to 5 years perspective, if you can, throw some light on it, not yet.
Well, I am a firm believer that corporate travel will be back and will be back very strongly. And it's a matter of a few more months at the most when there is a vaccine. But also, the work from home for the tech companies is there to stay. It's not, as I said in the presentation, some of the changes are short term, some are medium term, and some will be there forever. It's like getting through security at the airports. Before one could go in the airport, now you cannot go unless you have a boarding pass. You could enter hotels and leave them without going through the baggage check and putting your mobile away and the scanning, etc. So some of these things are there to stay forever, but if anyone believes that now business can only be done on Zoom or like what we are doing now, and we will never have a investor meet in our crystal ballroom, I don't think that is true. It is just, if it's not 3 months and it is 6 months, and if it's not 6 months at the most, it is 9 months that we will be meeting you in person and doing these investor meets. So I have been traveling. I've been to all major metros. I've been to Hyderabad. I've been to Bangalore. I've been to Delhi. I've even traveled abroad, and I'm going again at the end of this week. Some private, some on business. And I can tell you, I've seen empty airports in July, and I've hardly seen flights. And now I see almost a lot of activity. And if you look at the latest statistics prepared by, I think, Make My Trip, and it was on a CNBC channel, the growth in September over August was 40% in air traffic. And as per also the Minister of Civil Aviation, a lot of traffic is back to pre-COVID level, and all of that is not leisure. Some is also corporate. So I think it will keep increasing as time goes by and as numbers keep coming down in terms of infections. However, and having said that, if there would be another second wave, which nobody believes in India, like there has been one in UK or in the other parts of Europe, then it's a question mark whether it's a 9-month story or a 1-year story or longer. But the way things have moved in the last 60, 90 days, I can tell you not a projection, but based on my personal experience of traveling to these cities, that there has been a marked improvement versus when I first came after my first trip, maybe in July or something, and it was like you end up in a haunted airport. There was hardly anybody around in Mumbai. And it was also very carefully opened in Mumbai. It took much longer. Delhi had started, but Mumbai had a lot of breaks on, and corporate travel or corporate business has a direct correlation to corporate travel. And most of the corporate travel does not happen on drivecation. You don't drive to destinations unless you're at a ginger level customer. You're usually flying from one destination to the other.
Sure. This is very helpful. I just have one last question. Firstly, it's good to see, we turning EBITDA positive in September. My last question is, how is the overall booking for coming up for the holiday season, and any early signs you are seeing would be helpful if you can share. If possible, to also quantify bookings for the holiday bookings, compared to the last year, where we stand, if you have that, any kind of a rough estimate around it. That's all, and this is something.
See, the thing is that there is a lot of pickup is become very short term. If you had asked this question 3 weeks ago, I would have said it's slow. But in the last 3 weeks, we have picked up a disproportionate amount of business, and especially for these 3 months, October, November, December, because when I say 3 weeks ago, it included the remainder of October. So last 10 days of October for us, and going forward, November, December, have seen a significant pickup. But as your question, the previous question rightly pointed out, and also the previous person who had raised questions from HSBC, most of these pickups that we are seeing is on leisure, and obviously all of it is domestic. We'll see what happens once international travel opens up. And on leisure, definitely Rajasthan is leading the way. Goa is leading the way. Coorg and areas around Coorg are leading the way. Shimla, Rishikesh, these are destinations that are doing very, very well. And if somebody is going to Shimla, then they're also stopping a night in Chandigarh. So a lot of those kind of travel is happening, and there is a lot of pickup on that. Definitely, Christmas, New Year, we are seeing a surge in bookings. And the destinations I just mentioned, I can tell you, they might even be performing better than last year.
Okay, thank you.
Thank you. We take a next question.
Yeah, hi. This is Costa from Rare Enterprises. So I just wanted to understand, what did you exactly mean by you've turned EBITDA positive in the month of September? Did you mean for your standalone business or the consolidated business as a whole? And also, could you just go a little bit more into detail in this as to how we have achieved this and the key components to this?
Yeah, sure. I think we did see that both in standalone as well as in consolidated. I think in terms of general EBITDA positivity, what we're now seeing is that with the pickup of business, we are slowly seeing the increase in the number of hotels which could potentially break even on EBITDA actually. And I think that is definitely now the language has changed. I would not use the language in the first quarter, but as the second quarter progressed and the unlockdown has happened, we are gradually seeing that hotels will start becoming EBITDA break-even, hitting EBITDA break-evens actually. So that is definitely a trend. And therefore, we are looking forward to Q3 in terms of business to see how many of the hotels get to EBITDA break-even and what does it do at the network level. As far as September month itself is concerned, I think it was aided not just by operational incomes, but it was also aided by the non-operational incomes, which resulted in the EBITDA positivity in the month of September. And I think one of the things I want to emphasize, both operational and non-operational, is that these are extraordinary times anyway. And therefore, I think what is very important for us, Koskar, is that it is nice to see a marker which says EBITDA positive, which we have been wanting to see for a long time. So I think, frankly, it doesn't matter whether it comes through operation or non-operation. September was definitely aided a little bit by that. But the bigger picture, as I said, is that as the performance improves, I think you will see cities like Goa, cities like Delhi, cities like Bombay slowly start getting to EBITDA break-even. I think that is what is the more important thing, and that's why this quarter, Q3, is important for us to see the pickup in business and achieve those milestones actually.
Okay, could you what was your occupancy rate in September on a standalone basis for the domestic business?
Yeah, I understand.
Where just trying to relate EBITDA positive to your occupancy rate, and then
Sure.
The remaining would be non-operational. That's why.
So as you saw in the presentation, the occupancy in September was about 34.5%. That was the occupancy in the current year in standalone for the month of September. And there was, as compared to 30% in the month of August, the ARR definitely jumped. That's the other thing. It was not just an improvement in occupancy from 30 to 34.5. The ARR jumped from 5,087 to 6,500, which is nearly a 30% jump in ARR. So I think the quality of business, because as I said, the quarantine price came down and the FIT business is picked up. So I think it's a combination of occupancy increase as well as rating, which is where we saw the percent actually.
Okay, great. And lastly, when you speak about non-operational income which aided EBITDA turning positive, could you speak a little bit about this? Do you mean the food service business? What else do you mean by non-operational?
No, Kaustav, I think if you see the standalone exceptionals that we have just highlighted in our presentation. So we had a couple of standalone exceptionals. Like, for instance, number one was the lease rental concessions under the Ind AS comes as, in the top line. But to be honest, even if it is taken as expenditure, the EBITDA positive would have still occurred actually. We had a fair valuation of one of our financial liabilities, which gave us about 20 odd crores in the exceptional. So that is the only thing which came in, which is, I would say, non-operational. There was a small sale of flat which gave us 3 crores or so. That's all.
Okay, and any progress on our monetization strategy, simplification of organizational structure, anything from last quarter which is moving towards the right direction?
I think as we have always discussed, monetization is something we are progressing on. One or two of the monetizations, they are work in progress. I think some diligences are going on. So hence, I think my sense is that in the next 3 months or so, we should be able to announce the first of the significant monetizations actually. As far as the restructuring, if I remember you right about restructuring in terms of structures, I think that will take some time.
Okay, thank you so much.
Yeah, thanks, Pastor.
Thank you. We take the next question.
Yeah, hi sir. Sumant here from Motilal Oswal. So my question is particularly for the international business performance. So can you give more update on that?
Yeah.
Sure, Sumant. It's a mixed bag. I'll just give a little overview and then let Giri give the details. Dubai, because of IPL, is doing very well. The hotels in the US and Cape Town have just opened in October, so they are not included in first half performance because there was a lockdown out there, and especially in the state of California. When it comes to Maldives, it's picking up quite well. Sri Lanka had started and it went into a lockdown, so it's completely shut down. Bhutan for us is also shut down. So I think London, which we were expected to do much better, has gone down into a lockdown as of today or tomorrow for a month. But the positive on this London and US is there have been a lot of packages given by the government which reduce your both fixed cost and variable cost, which is in our control. So the impact on profitability is pretty much marginal versus last year. I would say in the same time last year. Is that fair, Giri, to say?
I think London, yes. London, I think what has happened is that significant savings in London. Very clearly, absolutely. Yes, that is right.
Okay, and what about the US?
US also in US. Sorry, go ahead.
Yeah. No, I think the US businesses were certainly down. Expenditure, there was significant expenditure control because, as I've explained, Sumant, earlier, about 85% of the unionized staff, we were able to do a temporary layoff for 6 months or so, and that resulted in the significant manpower savings. We were also able to follow and make some changes to the permanent staff there. I think that definitely helped. We also, as you know, renegotiated the lease rentals, these discussions with 795 corporations. All of those have definitely helped in terms of the reducing the cost there. And you also see, of course, however, US, there are cash losses because of the nature of the operation, and you have seen it in the standalone exceptionals. There are 29 crore loss that we sort of reported in the standalone, which is reflected under exceptionals for standalone.
Yeah, can you discuss more about the overall key customer mix changes in the key market like Mumbai, Delhi, Hyderabad, Bangalore, and from where the demand is coming, like wedding or staycation and any other?
See, the demand, Sumant, is different in different places. When Mumbaikars want to drive to Goa or take a flight to Goa or to go to Nasik or to go to our newly opened Ama homestay in Lonavala or Mud Island, that's one way of getting the business. The other, what we are seeing in Mumbai is a lot of staycation. It's people who live into hotels for a few days or nights because they have either bored or fed up of staying at home. So a lot of that is happening, and the rest is you have some airline crews that stay with you. You have some other regular wedding business. The very famous wedding that recently happened at Taj Mahal Palace and Tower. So it brings in some business. Doesn't bring in any more 100, 200 rooms because so many are not allowed. But it does bring in business, and especially in the wedding season, we are seeing a lot of this occupancy coming in through that source. Limited corporate travel, more leisure.
Okay.
And sorry, just to add, we are seeing Sumant also people coming from places like Gujarat and Pune to Mumbai and stay in Taj Mahal Palace Tower. That also we are seeing, or in Taj Lands End.
And how is the IT companies staff were staying, or pharma industry staff were staying? So this kind of customer is still there, or?
It's Pharma is yes. The answer is yes, but IT is no, because the people who are best to work from home is IT, right? So we have seen a short-term reduction or fall in that IT source of business where it was coming from IT companies. And there maybe for the hotel business, the recovery for the next 3-4 months will be slower. But what will not be slow is, as I said before, the festivals, the weddings, the celebrations, and the normal corporate travel. It will come. It's already coming in. Slowly, but it's coming.
So how is the inquiries for December and January for the wedding, for the year end and New Year?
We already answered that some destinations are even expected to do better than last year, and some are not doing as well. I think what we are waiting for is for the big metros to kick in. Delhi, Mumbai, Bangalore. If they kick in stronger in the next few weeks, then we can take that offline. You can give us a call in a few weeks' time. We are expecting that, but we have not yet seen it. However, as I said, leisure destinations of Rajasthan, Goa, south of India, even Fisherman's Cove outside of Chennai, these are doing very well on the weekends.
So can you give us 135 crore the sales from new initiatives breakup? Which segment coming more apart from swimming and all?
Can we discuss that offline so that we can give you the data?
Okay. Thank you so much.
Thank you. We now take the next question.
Hi, sorry, this is Achal from HSBC again. I had one follow-up question. So just want to understand, basically, as we are finding that the leisure demand is picking up, and then of course we are entering the most busiest quarter, that is quarter December. But then what happens as we enter into the next quarter? Because then the leisure demand anyway will decline. Usually there's no leisure, and the corporate travel demand is slow. So how do you see following this quarter? How would the business take place? I mean, how the demand will happen? So if you could please talk about that.
Well, we are seeing, as we mentioned before, a recovery in demand. Leisure is strong, but hopefully the other segments start coming in too. You're right that after 15th of January, leisure will slow down. But in such a historic circumstances that we are all, are shocked and surprised with, when revenues also hit zero, or as I said, they were as good as nothing was there, then you see those jumps. And at some point of time, we started getting Vande Bharat, and we had the medical staff, and then they got replaced by higher paying people, as Giri just now mentioned. And the rate changed, but not the occupancy to that extent, because the lower paying business replaced. Now, when did our industry ever do Vande Bharat or medical staff? So something or the other comes up and will come up going forward, as the impact of lockdown is beginning to get diluted on all fronts. I think you all see it on the roads. 3 months ago, there was not a person on the road, or after every 2 or 3 minutes, a car used to pass by. Now suddenly, if you go to Pedder Road, Chowpatty, whatever, Marine Drive, they're full. If you go to Delhi, it's the same. You try to go from airport into the city and you get a lot of traffic. So I think similarly, traffic and normal business will keep coming back, as has happened with the human civilization for thousands of years. So at some point, there will be an end to this also. It's not going to stay there forever. And when it ends, people will start traveling.
Right. No, fair enough. Thank you. Thanks very much.
Thank you. We now take the next question.
Hello, am I audible?
Yes.
Hello?
Yes.
Yeah, so my first question was, can you give some breakup between business and tourist locations, hotel and inventory? What would be the difference between tourist and business and tourist locations in terms of occupancy, if you can give some light on that? And can you tell what can we do to improve the performance in hotels in business locations? And some of the business locations or a city like Delhi, Bombay, where we would have multiple hotels. So can you give your thoughts on that? Yeah, I am Himanshu from PGIM Mutual Fund. This was the first question.
See, I can tell you the trend is like this, that for us, Goa is operating at almost in the last 6 weeks or so, or the 4 weeks or so. And going forward, we are expecting around 80% occupancy in, let's say, the established properties that we have under the Taj umbrella. And the business hotels are at around 40 in the cities you mentioned. With the exception, one hotel in a city could be at 60 and another one is at 40. But yes, there is one hotel in Delhi which does 60 for us. So what can we do? We are doing and putting a lot of initiatives, as I said, in place. Up till now, you've seen a lot driven by wellness, by staycation, by the 4D, which are more linked to driving to a destination. And now you will see us rolling out more and more corporate packages. And we think that way we'll be able to stimulate demand. But there is no point, launching corporate packages when a lot of companies are saying that their people should not travel or avoid travel, right? So that's a wrong time to launch a package, I think, but that is slowly subsiding and a lot of people are traveling now.
Okay. And yeah, second question was, what type of trends in booking you are seeing in the winter vacation period? What would be our plans to have good occupancy at that period of time when a lot of foreign tourists used to come for a long holiday season? Can we expect to get more domestic tourists to fill that space as much lesser people from India will move out? And any specific thought process or work we have started for preparing for those longer winter vacation period? Some thoughts of yours on those trends and how the most profitable period.
We are seeing good demand for holiday season. That's not a problem. If there are foreign tourists not coming in, there are also 24 million Indians who used to travel abroad who are also not going because it's not allowed to go. So that is your captive clientele. Definitely, there is a segment that used to pay a big premium from coming from abroad on our palaces, which are 7 to 8 palaces that we have in our portfolio that used to attract a huge premium from people of especially foreign origin. That segment is missing and we are working hard to compensate for it. But that's limited to 7, 8 or maybe 10 hotels in our portfolio. So we have more than 160 hotels in operation.
Okay. But looking at the trends, do we expect the occupancy in the winter vacation period we can reach back because of Indians or the inquiry levels, what you are seeing? Can we reach those levels back in this winter season? Or how you would...
See, as I said at the outset of the presentation, in April this year, we went to 7% versus 75%. Then as just now my colleague Giri mentioned that on Standalone, your previous speaker had asked that question. We were at like 34-35% in Standalone in the month of September, right? Now, that 7 went to 35, which is 5 times more in 5 months. And we are seeing similar kind of trends on a month-on-month basis. The jumps are higher because you are coming from such a low base. So, no matter how high the jump is, it will be difficult to get to the same level as November, December of last year. Why is that? Because also the calendar last year was a bit different, and November, December were the two best November, December that one has seen in several years. So last year the November, December figures were very high. It's difficult to get to the same level for us. That is not only difficult, I don't think that will happen. If we get to 75% or 60% of that level, we would be very happy because we are coming from, as I said, 7%, 10%, 15, 20, 25, and we presented that ginger is back to 53% of the revenue of last year for the first half, right? So that is something we have to very closely monitor, but everything moves in the positive direction and on the way up.
Okay. And yeah, one very interesting slide on and data on Ginger hotels. Okay. Can you please tell what would be the reason for such good occupancy and performance for Ginger hotel? And secondly, can we replicate some of those things at Vivanta, which is a business hotel but at a premium to Ginger? And would it be right to say if we remove the occupancy of Ginger hotels from domestic network, the occupancy would be in 20s in that case? So these on Ginger hotels. And one more, which would be the last. But if you can reply to this, it would be helpful.
See, Ginger, the number of rooms is much smaller than the rest, so it will not go into the 20s. It will still get closer to 30 and above. So that is not, I don't think that's the answer, but Ginger as a brand has been significantly repositioned in the last couple of years. So what we call the Ginger entered the lean lux segment, and 10 of its properties were already refurbished, repositioned, plus the new ones that have been opening. The second thing is in many other locations it has benefited because it's got a strong footprint in secondary and tertiary market. So it was not having so much of competition. For let's say a Ginger in Agartala was taking all the demand that was there in Agartala. Newly opened Ginger in Patna was doing very well. A newly opened Ginger in Kalinganagar is doing well. In Patna it was doing well because there is Bihar elections. In Kalinganagar it is doing very well because there was nothing else in the state of Odisha in this town. So a lot of Ginger benefited from that, but also Ginger benefited in places like Mumbai because Ginger was also hosting the medical staff. So Ginger Andheri Teligali or in Ginger in Andheri Mahakali did exceptionally well. Ginger in Margao in Goa did very well. Ginger in Panjim did quite well. So there are different markets, different dynamics, and we think this brand will continue to do well as time goes by. I've said it in various interviews and various conversations. It's a brand to watch, but it's still small. It has 75 hotels in portfolio, of which there are 51 in operation. But these are small properties. Now we will be doing big boxes or bigger properties, larger properties, and then you will see more and higher impact as and when they open.
Okay. Very interesting insights. And one last question. Once the business revives of hotel occupancies and dine-in restaurants, let's say 6 months to 1 year down the line, how would we look at these new initiatives like Qmin? And do you think at some point of time we'll need to invest in these businesses which we are seeding now, or what would be our thought process? Because what seems these are interesting ventures, but just once the occupancies come up, how will we look at these new initiatives, what we are seeding currently? Just some thought process behind that.
See, yes, this is not a short-term initiative for us. We thought through this, and that is why we developed our own app also for it. So Qmin is now live in 12 cities. We would be going to 20 plus cities, and we'll be doing several Qmin shops. The second one will come at the Ambassador in Delhi. The third one will be at the Connaught in Delhi. There will be a fourth one in Mumbai, but outside the hotel. So all these plans are already in place, and As I said, this is not that now pandemic is over, this is over. We would like to capitalize on this and take it to a professional level as a line of business. We never thought the need for it because the people waiting outside the restaurants were so many. So there was no need. And as they say that sometimes you reinvent yourself when there is a need. And this is how this line of business came. But this was a very large business even before the COVID. It was always there, the home deliveries. Only hotel companies were not participating in it. And now hotel companies have come and become a disruptor for those who were doing it in this business, just like OTAs came and became the disruptors for hotel reservation systems.
So lastly, you would like to invest in this business if it is required, na? That is very clear at some point of time, 1 year down the line.
See, we don't see any significant investment in this because we have the kitchens, as I said before, we have the staff, we have the connect to the guests, we have the various our own list of guests and our platforms where we have access to those people, whether they come through Chambers, which is a club proposition, or they come through Taj Inner Circle, or they come through our strategic partners like American Express or HDFC or HSBC, or I would say the entire banking world, or they come through any other source of various Tata Group companies. So we have a very large base that is there, and as I said, we want to get to a mature phase of this business and to grow it further. We have no reason to now stop.
Okay. Thanks and best of luck for the future. Yeah, that's all from my side.
Thank you. We take the next call. Sorry, sir.
Yeah.
Please go ahead, sir.
No, I was just